I don't think that the way you build a big company or the way you get a big exit is by investing in the most ambitious companies growing the fastest. Those are also the companies that crash and burn.
This is Adam Fisher, partner at Bessemer Venture Partners. He is one of the most prolific early-stage investors in Israel, with some of the most successful company exits, including Wix, Fiverr, and Habana.
I see my role as a VC as picking up an entrepreneur when they're like on the ground, but also pulling them down when their head's in the clouds. The entrepreneurs that come to me, they realize that I have that balance. When you react to entrepreneurs, whether it's good news or bad news, with some kind of composure, they become more transparent with you.
What's the best investment advice you've received?
There are two pieces of advice which are contrary. The first is,
Adam, I am so excited for this. I stalked the shit out of you beforehand. I spoke to Byron, Amit, Daniel, the list goes on, but thank you so much for joining me.
thank you. It's a pleasure to be here.
Now, I would love to start with your entry into venture. We had a little chat about it before. Tell me, Adam, how did you make your way into the world of venture and come to be at Bessemer today?
So it was serendipitous. I was a student. At the time, I was an undergrad at Georgetown University, and I did a one-year program at the Hebrew University of Jerusalem. And in my first days, I was looking for an internship. That's just what we did at Georgetown. Every single semester, I had an internship somewhere. These are unpaid types of roles where you learn. And somebody pulled out, they went through this like box full of like letters or faxes. And they said, well, here's one. Now, I told them I was interested in business. And it was for a venture capital fund. Now, it's serendipitous because literally a month before, I had read an article about venture capital in Israel in a now defunct Israel-American business magazine called Link at the time. And I just leapt at that opportunity. I said, yes. Now, nobody knew what venture capital was at the time, certainly not in Israel, but also not in the United States, not at college students. And for years, I would tell people what this was and what I did, and they would kind of, didn't look at me
And
with
this
a
is
strange
1996?
face. This is 1996. And so that's how I got started as an intern. This was a tiny fund. All funds in Israel at the time were tiny. We're talking $15 to $20 million funds. There was one partner, one secretary, and one internet connection. And I had to ask the secretary to get off her computer so I could search the internet. This is pre-Google, obviously. Business plans would come in the mail in a big fat manila envelope. And I like to say that those business plans actually taught me more than my undergrad degree did, because they really spent a lot of time explaining everything. And these were very technologically oriented companies. So that's how I got started. Very young, I'll admit, very early.
Can I ask, when I listen to you there, I think of actually Doug Leone's statement that we've moved from a boutique high-margin business to a commoditized low-margin industry. When you think and compare the two different times, which do you prefer operating in as an investor?
Well, I prefer now.
You do?
Just because of the experience I have. Back then, there weren't many people you could actually learn from. And even if they existed, they didn't write down their thoughts. You couldn't access them. It was a very closed industry. It was not only local, it was very closed. Nobody shared their investment strategies online the way we do now. Nobody even exchanged their war stories or what went right and what went wrong. So it's a much more open industry. And I think it's not just that other investors benefit from that and new investors. I think entrepreneurs do as well. And so that openness now that you have with entrepreneurs is refreshing. I worked back then at a time where it was a much more adversarial relationship with entrepreneurs. The VCs kind of acted as if they knew what they were doing, that they knew the right way. A lot of these VCs were former maybe entrepreneurs themselves, or at least executives in larger corporations. And the relationship was one of very, very paternal, if I might say.
In a good way or a bad way?
No, in a horrible way. I hated it. Also, being a very young and inexperienced venture capitalist at the time, I didn't like it. I didn't like seeing that. And one of the things that I eventually did myself when I started at Bessemer, this is in 2007, was to take a very different approach, to take this kind of partnership type of approach with the entrepreneur. Because I realized what they really need is not somebody to tell them how to do it, but a partner that they can confide in, that they can tell them what good happened today and what bad happened today without hesitating.
Do you think we've swung, you're like, we have this schedule, Harry, why do you go off it so soon? Do you think we've swung to a time of too much founder MPS? We often actually see that investors don't perform their duties in a rigorous way like they maybe would have done, and they're too focused on having a great MPS. Do you find we've swung too far the other way?
I don't think it's NPS. I think it's the speed. There's something about the speed that is not fair. It's literally speed dating. It's speed dating where the outcome is actually a marriage proposal, because that's what founders are doing when they're choosing their VC and partner. They're essentially adding another founder of sorts. Now, of course, they don't get common shares. They don't get that rights, but there's a higher likelihood that that partner from that VC will be on your board than your co-founder will, just statistically. And yet you want to make a decision as an entrepreneur within 2 meetings, within 7 days. That to me is horrible. And as obviously from an investor standpoint, having been on the board of companies for 10 plus years, I realize that I also don't like that. My worst decisions have been the ones that I made in the least amount of time due to pressure.
So do you do those deals? I mean, I'm looking at a deal now, and like, honestly, it's a very competitive deal. I'm meeting for the second time tonight. I'll probably have a third meeting on Wednesday, Thursday, and then I've got to make a decision. Do you do those deals?
I don't, but I think when it's a smaller check, when you're amongst other VCs that could take your place if you bow out, I think there's a place for that. I'm talking about the types of deals where I'm the only VC in the round. I'm leading it. If I move forward, it's me. I assume all the burden going forward. I can't withdraw at any point, or if I do withdraw, it's the end of the company. Those are real decisions, fateful decisions, and to force that to happen in such a short amount of time is crazy. I mean, I remember a time when it was 3 months to diligence a company and get to know one another. And I actually enjoyed that process. But when it's so concentrated in time, you're going to make a lot of mistakes.
I always think, bluntly, for pre-seed or seed, the best thing is when you know the founder so well that you actually don't care what they're doing. I call them the blank check founders, where you're like, you know what, I've known Adam for 5 years. I've seen him across these different situations. I've seen him execute in these different environments. I don't care what he's doing. Real estate, healthcare, I just buy him so much for pre-seed.
Yeah, maybe. I have a different view on that. I've had the privilege of having backed many second-time entrepreneurs.
Yeah.
And I challenge them because I think they're second-time entrepreneurs who sometimes they're somewhat blinded by their previous success. And they think they can do anything. And they want to build something bigger, typically. Nobody wants to build something the same size, even let alone smaller. And their idea about building something bigger is being more ambitious, raising more money, a higher valuation. But that's actually not the way in which you build something bigger.
Do you find that, though, or do you find that actually they're a lot more rational, going, gosh, I'm aware that if I raise too high a valuation, it'll cap me on my next round, it'll put a lot of pressure on, the options will be higher. They're much more intelligent about the price they raise at.
So that's the other style of second-time entrepreneur. And those types are also the ones that want to hear feedback. They actually want to brainstorm with me. They want to share the idea and they want to hear pushback, or they want to hear confirmation. But if they're so certain about the idea at such an early stage, to me, that's a bad signal.
Adam, I'm loving this. So I always get pushback from the team here because I don't love first-time founders, because I look at myself, I look at many that I've worked with. There's so many mistakes that you make as a first-time founder that if you had your time again, of course you wouldn't have made those mistakes, but you waste months and months doing them. I find second-time founders do not make those very foundational mistakes. Do you agree with me in terms of my kind of fear of the first-time founder because of those very obvious mistakes that they make commonly, and lean towards second-time founders? And how do you think about that? And advise me.
Like I said before, there are two types of second-time entrepreneurs. There are those that don't recognize the luck that was involved. They think that building something big is just more ambition, and I steer clear of those. And then there's those that are much more rational. And those I will back again. But do I prefer them over first time? Not really. I actually love first time entrepreneurs. The key for looking at first time entrepreneurs is identifying somebody that you have chemistry with, that you have back and forth from, that they can learn from you, you're learning from them. It's also people who progress very fast on the learning curve. Meaning from meeting to meeting, you can witness what they've discovered, what they've learned. other people that they've discussed it with. That is generally an indication of what the next several years are going to look like. And the fact that I haven't created a company before doesn't mean they can't learn from other people's experiences and from your own experience. And so for me, that's fantastic. I often look at my portfolio, and I have a lot of second-time entrepreneurs, but I often say, I need more first-timers. I shouldn't have such a bias to second-timers.
In terms of those first-timers or second-timers, there's two ways you can approach a market or a company. One as an insider, I've lived that problem, I know it to a T, and I'm going to build to solve it. Or another way, you almost have the benefits of naivety and you solve it as an outsider. Do you have a preference on which approach is taken? And what are your lessons from what's worked and what hasn't on which one is more effective?
Like the outsider approach. It's common to Israel because Israelis typically are coming from outside, not only physically from a market perspective and industry. It's just also the attitude. The Israelis think they can do anything. But I find they just bring a lot more innovation and openness. Of course, again, they have to figure out what they don't know, and they have to recognize there's a lot they don't know. So as long as there's that self-awareness of, I don't know anything and I need to figure it out, they can be the best because they can innovate in ways that insiders can't. Insiders are just blinded by convention, by knowing a little bit too much of what hasn't worked in the past, of where others failed. Naivety is a strength in these cases. And if you have the right entrepreneur who, again, is self-aware and perhaps also has a certain degree of charisma, meaning to kind of sell a vision, both to his employees and investors and eventually to customers, it's incredible.
Okay, so if we have that as like a foundational, we like outsiders who are innovating in markets with some elements of naivety, then there's the question of like category creation versus working in an existing market. How do you think about that trade-off? Often we see the biggest wins in category creation, but it's also fucking hard. It's expensive. Which do you prefer in that lens?
I think if you're, from the get-go, if you're talking about creating a category, you're making a mistake. I think a lot of times when we talk about category creation, it's in retrospect that we see that a category was created. It wasn't started that way. It became an independent category. And it's typically not because that one company created it, but because there were multiple companies with very similar mindset. And sometimes that also includes some of the incumbents who are also moving in that same direction. And luckily, you were ahead of the curve. But if I was to start and make an investment that is trying to create a category out of nothing, it's challenging. I think where category creation makes sense is when they've identified a new type of customer or a new type of buyer. Perhaps it's a new vertical industry. If you decided all of a sudden that e-commerce was a new vertical segment that I wanted to sell into, meaning e-commerce shops, that would be an insight. It's not so much a category creation. The category is being created. You're now creating a product for that category. Or if you were to decide that I'm going to sell into the developers within organizations from the bottoms up, they exist. You're not creating that category, but you're essentially identifying a need and a new buyer with a product. That makes sense. Again, in retrospect, you'll say they created a category of developer SaaS. It's not exactly true.
Mike Maples at Floodgate, an investor in the US, always asks, what do you see that no one else agrees with? And then you have this kind of insight development process that takes place post that, which I find really interesting as a question to ask. I guess kind of when we think back to that, you said there about, many people can create a category in retrospect, but many people going after it kind of ushers a movement forwards. I don't like to be in companies where it's what I call like N of one, where it's like there's 6 different SaaS pricing players. And you're one of many, Excel funded one, Sequoia funded one, Bessemer funded one. It's kind of like race. I like companies where really it's kind of just them doing it. Mm-hmm. Do you agree with me?
Totally.
Yeah.
I think there's 2 types of investors out there. There are those that get comfortable when there's competition, and they get comfortable because that gives them the sense that there's investors out there willing to put money in it, and that there must be a market if multiple people see the same opportunity. But I'm the other type. I say, oh no, there's already competition and there's not even a market. And that competition can attract the better talent, or they can raise more money, or maybe they'll get acquired by the only potential acquirer. I get comfortable when I think, well, it's only us. But if we're right, we're going to be the leader.
Did you always have that? Because that takes confidence and conviction in yourself. And when you're young, you question yourself. I know I do.
Well, I have to think back. That's many years to think back. The pace of investing was so different back then. It was one investment every 18 months. I did a little bit of both, including investing in companies where there was lots of competition, and deciding that despite the competition, this was the one. Only have really one case that I'm thinking about right now is a chip company called Dune Networks that made a switch fabric chip. This is back in the year 2000. I'm really dating myself. But they made a very compelling argument why all the competition belonged to a different era and a different architecture, and how they all had the same fundamental problem and how they were going to succeed. And they convinced me. And I remember when I wrote the investment recommendation, I had to list 20 different competitors at the time. This is in the late 90s. Fabulous chip companies were funded, left and right. They were acquired and even went public with design wins, not even revenues. So the idea that most of them would fail never really crossed my mind. I just thought this one would succeed. In retrospect, they all failed except for this one. Now that doesn't mean I can be right in the next one, but I think over time I realized that it's a better arbitrage opportunity to be the lone player or the first mover even in a smaller market, even in a niche market, than to be the number 2 or 3 in a large market. Because a number 2, it's like a gladiator competition. Number 2 is still a loser most of the time.
I totally agree with you. Have you ever got in trouble, though, for having that contrarian approach in terms of follow-on funding? You see the world in a way that venture investors maybe don't, and you do a non-competitive deal that's outside. That probably is not going to have the same magneticism for follow-on investors, and you might have to carry the bag for a lot longer. Have you had that?
Of course, and I think about that when I invest. Yeah. As much as I am willing to be contrarian, I'm not willing to invest in something that others are not going to fund. So I need to find, it's a fine line, but I need to find something that perhaps is not mainstream, perhaps is not yet a headline in TechCrunch, but is also not going to be dismissed by other investors as not interesting. It may be because of the entrepreneur, it may be because some of the trends that this company is riding on, but I'm not going to go completely contrarian and do something that everybody says that they no longer do. Making sure that next round of funding is accessible and doable is a critical part of my strategy. It's so easy to fail by simply not being able to raise that next round of funding.
Mm-hmm. What does that look like, though? Do you map out in your head, these are the 3 players that I know would invest in this next round. This is a type of deal for X. Or do you just generally have a smell test of, yeah, I can feel that other people would like this?
Right. I don't think in terms of specific investors ever. I could never have predicted. It's easier to predict who will acquire a company than it is who will invest in the company. It's a combination of the entrepreneur, the CEO in this case. Will they be able to raise money? I invest in people who I think can raise money, even when they don't meet their plan. It's so important. I can't emphasize this enough. The ability to fundraise with ease, and we can talk about what that person needs to show, but if they're a storyteller, they've got a history of execution, and they connect with like-minded investors. The second thing is...
Can I just dig in on that one while we're there? Sorry, because I don't... In terms of the ability to tell stories, be a great fundraiser, I think one thing that's challenging in the last 2 years in zero interest rate environment is you got some great storytellers. With a wink and a smile, they raised $50 million and they were great at storytelling, but there wasn't much depth to them. Do you worry that often the great storyteller and the great fundraiser isn't actually the great operator and executor, and actually sometimes the quiet but diligent person is the better one?
Absolutely. When I say storyteller, I don't mean somebody who can perform on stage or a podcast. I mean in a one-on-one conversation.
I'm not going to get funding from you today, Adam.
I mean in a one-on-one conversation with customers, that they can give a pitch to the customer, that they can identify the customer's pain and explain why their solution is going to work. And of course, you can't just raise on a story. you have to have some execution behind it. You have to show that you've delivered the product that's working, that there's some customer love, that you've been very efficient, that you have plans that make sense. I mean, any early stage company that's raising $50 million, I don't know what stage that was that you were thinking about, it's inappropriate. Those are not the type of entrepreneurs that I back.
I mean, in the last few years, it could have been a pre-seed at that rate.
I would not have been involved.
It would not have been a deal for you. I totally get you. Can I actually say there about efficient, before we get to your second point? You're like, God, I really drill down. But you said about efficient. For founders that listen, is there been a fundamental mindset shift in you and how other investors think in terms of when analyzing a company, I want to see efficiency, not just growth? Or actually, does growth still rule all at the early stage?
It's a combination. It's rarely growth at all costs in my book. That just doesn't last, and it's very painful when it stops. Everything about your model, to your culture, to where you source funding, to your evaluation becomes a serious problem for the company. Having said that, trying to focus on KPIs when a company has $500,000 of ARR also doesn't make much sense. Those numbers are, if they're fantastic numbers, I say it's anecdotal. And if they're horrible numbers, I say, well, we need a bit more scale to make sense of it. The important thing is that the company and the CEO in particular is thinking about efficiency, that it's an important attribute for them, that they care about it, that they're not just trying to satisfy me as an investor, that they also view it as a key to their own success.
So I am really learning here, and so this is a teaching session. What are signs that someone cares about efficiency? Is it in terms of how they talk about, ramp time for sales reps? What is that? This founder's got a good eye towards efficiency.
It starts in the very beginning. I can't tell you lately, or at least in the past few years, how often I met with an entrepreneur, and they were, raising money for their first round, and then it occurred to me that two of the founders are still working at their current employer. They haven't even left. They haven't even shown the most basic sign of taking risk. So now you might say, what does that have to do with efficiency? Well, generally speaking, taking risk is what it's all about. Using your own money, taking career risk, working from home in the first few months, putting on some debt on the credit card. These are really important signs. Now, those people generally go on to do things on their own, to meet customers on their own, not to hire a salesperson, but to actually figure out themselves. Wait, how do I pitch this? What are customers actually saying? These are critical steps. So you ask, what am I looking for? Well, if they've already established the company, yes, I'd like to know who made the first sales. I would actually expect the CEO to have made the first sales. Sometimes it's the CEO who's also written the first code. Those are signs of efficiency. Those are signs of somebody who doesn't want to hire somebody which is spending money before they know themselves that it makes sense, that they're going in the right direction.
I always ask, how did you first make money? And I find that that's very telling. The greatest entrepreneurs I find of all time, when I look at pattern recognition on the people we've had on the show, is all the best entrepreneurs made money or showed entrepreneurial signs in some way in their childhood. I made websites. I sold lemonade. I sold baseball cards, whatever. None of them came out of university and then got a job at McKinsey, and that was the first money they made.
Well, you're probably right. I think the ones that show an entrepreneurial streak in their background, they generally are entrepreneurs, but I wouldn't exclude others. Sometimes they just don't have the right environment. Sometimes they grow up in an environment that is a little bit too conservative, that doesn't allow them to explore that. So I wouldn't write off those who grow up in a more corporate state environment. It's certainly possible.
Another core element when we think about kind of unpacking the evaluation or the kind of decision-making process is always market size. And I find it's one where that and price, which we can get to, but where I've most commonly gone wrong, it's great. I love the founder. I just don't think it's a big enough market. It's so common for our industry. How do you think about market size? Do you need the massive market day one, or do you quite like the niche vertical approach which can expand? How do you think about that?
Well, there's some markets that any way you cut it, you look at it, you just say, this is never going to be a big market. That's a fair assessment. I think I've more often been right than wrong on those. I think, but there's a problem that investors make when, or even entrepreneurs as well, when they think it's a large market, but what they're really focused on is a small subset of that market. And that doesn't make it really any easier. I personally like to invest in smaller markets for two reasons. The first is that there's unlikely to be competition focused on that same market. And the second is that if you price it right, the deal that is, and you've come in at the right valuation, you can still achieve an exit in that smaller market, what you might call a niche. Now, a niche that has no potential of expanding, that is problematic. I like niche areas where there are adjacent sectors where you can understand they could grow this way, they can grow that way, they can go up market, they can go into a second related niche. I think that's a fine way to grow into a bigger market.
You said there about kind of, if the price is right in those cases, you can still have great investments. And I completely agree with you. I think multiple invested capital is what I care about, not necessarily size of outcome. If I get in at 200 or whatever it is and we sell for 5 billion, I'd rather get in at 6 and sell for 700, actually. But then everyone's like, oh, Harry, you don't get venture. Venture's about those multi-billion. Do you ever question yourself on going like, should I really be doing this investment if I'm thinking, it's an 800 to a billion outcome?
800 to a billion sounds
great.
Sounds fantastic.
But it's not what funds are made on. And especially like when you think about like Bessemer's size fund, it's not a fund returner in a lot of cases. Even if you think about 12, 15% ownership on exit. I mean,
I just have a very different approach being an early stage investor. That makes sense for later stage. Being an early stage investor, you have to accept that you cannot, the further you try and peer into the future, the less clear it is. And the more chance there is for surprises, both good and bad. I think when you invest in good people with compelling ideas in big enough markets, you just have to be a bit more imaginative for how it can unfold. Some of my smallest investments ended up being my biggest outcomes. And I was very hesitant to make them for the same reason. Who would buy this? How big could it be? What is it? And $2 or $3 million turned into hundreds of millions of dollars.
Can you take me to one? I heard that Wix was a very controversial one from Byron. But when you say that and you say, the small investment that turned into hundreds and you were quite nervous about writing, what's the one that's most poignant to you when you hear yourself say that?
Yeah, well, the easy ones are Wix and Fiverr for me, because at the time, I was the first institutional investor to come in both of those. The entrepreneurs themselves didn't entirely know yet what they were doing. It was too early, and I think many other investors passed or would have passed had they seen it. In both cases, I received what would be politely say very lukewarm feedback from the partnership. In fact, in the case of Wix, it was outright negative feedback, but it had arrived a little bit too late.
Why was it negative?
They didn't present well. I wasn't at all really focused on exactly how are they going to make money. I was just a little bit too focused on the entrepreneurs and the surface area of opportunity of being able to create anything you want on the web, which to me just seemed like the future. But I couldn't yet bring it down to a product and business model that was compelling. And so it's one of my toughest investments to explain in retrospect how and why I did it.
Okay. If you were to do outcome scenario planning, do you do outcome
We
scenario?
do.
Okay, so you do outcome. Is that not peering into the future? Like you said, that it gets less and less clear.
It is, but I don't like to think about it. Some people focus on what the outcome could be. It could be $50 million outcome, 0, 500 million, $1 billion. I actually focus on what could go wrong and what can go right. Forget the valuations for a second. Now, what can go right, we typically just think in terms of growth rates. That's oversimplistic. That's just not the way a company evolves. It's not simply a growth rate. A growth rate is a function of other things that are happening in the market, in their product strategy, in their go-to-market, vis-a-vis the competition, partnerships. That requires a lot of imagination, but it just shows you that there are avenues to get there. The harder part, and one we probably don't spend enough time in, is what could go wrong, because that's infinite as well. And we typically just again, talk about it in terms of growth. They won't grow very fast, or they might have trouble fundraising. But having done this for 25 plus years, let me tell you, there are so many other ways in which you can fail.
How often is what you think will go wrong the reason why a company does go wrong? Versus the Mike Tyson, the thing that will get you is punch in the face that you didn't expect.
The hardest, I think it's when I talk about the entrepreneur. It's when I'm unsure about the entrepreneur. I'm not always 100%.
And you've still written the check?
Yes, because I try and move out of my comfort zone. I accept that sometimes I have a lot of biases towards certain types of entrepreneurs, and I can't always invest in the same Adam Fisher typecast entrepreneur. That even though that works for me, it doesn't scale, and I'll probably miss out on some very good ones. But on occasion, my misgivings were about the entrepreneur. Something about it could be a lack of transparency or pure communication, or just some signals in the beginning that threw me off, and I wasn't quite sure to dismiss it as a bad first impression, or something that was going to presage what was going to happen now over the next few years. And so those are the ones where they're also the most difficult because you kind of saw it.
I totally agree with you. And it's kind of this nagging feeling when you're writing the check. Like you have it in the back of your mind that that's the concern. And that's when I'm like, one thing I don't ever do is like when I feel icky, when someone makes you just feel like uncomfortable and you just feels off. I never write that check. Can I ask, you mentioned Wix there, obviously being an incredible success and the lesson from it. In terms of a mistake and one that didn't go right, what's one that comes to mind there and how did that change your thinking?
The ones that haven't gone right, I can think about 4 companies that I've written off. They're not enormous investments. I've yet to have an investment where I kind of doubled down and kept raising the stakes and then failed. I'm not saying I won't, but I'm nervous about those big losses. The 4 losses I have are all about between $10 and $15 million a piece. The one I can think about most was a chip kind of company. They're actually doing something in the area of memory, and it was an incredible technology and team. Had literally 90 patents to their name, and they were pursuing what we'd call an IP strategy. They actually wanted to sell the IP, both because it's a more efficient model, but I thought it made a lot of sense for the types of customers they were selling into. I convinced myself that this is the right strategy, whereas their competitor was actually developing a chip. And I just said to myself, wow, but the customers that they're selling into are themselves large chip companies. They're not going to buy another chip company. They want the IP so that they can incorporate it in. Ultimately, I was wrong, and I mentioned this because I was convinced that was the right strategy. Meaning, I can't hide behind anything. I can say the entrepreneur made some mistakes, and he did. I can say a lot of things, but at the end of the day, that was my thesis, and the underlying thesis was completely wrong. And I really learned my lesson. And so, anybody who now wants to invest in an IP chip company, I'll tell them exactly why I was wrong. I also have reason. I still can explain my reasoning and explain why I was right, but I know a bit more, and it's enough just to say to have the opposite conclusion at the end.
To what extent is pattern recognition good or bad? Because you now have that experience, and I've lost money in healthcare, for example, and I go, it is so hard to make money if you're selling to any public healthcare provider. It is long sales cycles. I know all of these things. I don't want to touch it. And pattern recognition is really impacting my future decision making, positively or negatively. But is it a good thing or a bad thing?
On the whole, it's a good thing. I think it definitely helps you recognize winners that you've seen before, and gives you the confidence to move much more quickly than you otherwise would. At the same time, you're absolutely right. When you've lost money or you've seen others not succeed in that particular thing, it's very hard to say this time is right, this time it's going to work. But I would say that the best thing about pattern recognition over time is that you recognize what won't work. It's not what will work. Now, if you recognize what won't work, it will help you avoid spending time on bad deals or bad entrepreneurs, or if you're on the board of a company, bad strategies that is where pattern recognition is priceless. And it takes time and experience to develop that. But that's ultimately what I think I'm paid for and why entrepreneurs are attracted to me. It's not because I know the right way. It's because I know all the wrong ways.
I think sometimes our job as board members and partners is actually to tell founders the people that they shouldn't hire.
But that's it. That's exactly it. The analogy that I use is that we're not like the entrepreneur is the captain of the ship, but we're not next door shouting which way to go. We're like the lighthouse. We just tell them where the rocks are so they don't crash. But we actually don't know how to get there. That's the entrepreneur's job.
But I spoke to Daniel at Choco, who's one of your founders, specifically on this in the hiring process. And he said, when it comes to hiring, I want them to meet Daniel. I want them to meet Adam. And I want you as part of that interview process for candidates. I would love to understand from you how you do this, because I don't have a process. I'd like to learn from you. How do you structure the process of interviewing a candidate? What does that look like?
I don't structure it much. I think I don't want to duplicate the interview that the CEO had, which is about their background and they know what they're doing and what they did. I assume that he or she has already done that. I'm trying to find things that may not have asked. So I'm going to ask different types of questions. I'm going to assess the personality, their temperament, with the goal to see if they're a right match for this entrepreneur, who hopefully at this point I also know their personality and temperament and style, and for the company. And with the company, that's often really just the stage of the company. So often, it's just a mismatch. And so similar to what I said before, I'm not so much looking for, is this the best candidate? So as much as I'm looking, is this going to be a horrible hire that you're going to regret? Because as you know, if you've hired somebody and they end up being a disaster, you've lost an incredible amount of time. And there's also damage. And then your next hire, you're even more hesitant about making that hire. So I'm much more interested in not making a mistake with a hire than making sure that this is the best possible candidate we could hire. And a lot of that rests on the personality. Do they understand what it's like working for an entrepreneur? Do they understand what the stage is like and what they actually need to do? Perhaps they need to roll up their sleeves more than they're familiar with. Perhaps they need to hire on their own instead of relying on a recruiting team to hire. Perhaps they need to travel much more, or it's international as opposed to being very local. These are all the types of things I'm trying to look for. And so I ask questions about them to understand what experiences they've gone through. How have they handled stress? How have they handled sensitive personnel situations? How have they handled disagreements or other types of macro crises? And slowly I can try and figure out what this kind of a person this is, and are they a good fit?
What happens more often, a mismatch between the talent and the entrepreneurial style, or a mismatch between the talent and the stage of company that they'd be entering into?
The latter, because hopefully I've done my work and I've figured out the personal chemistry, and the founder is pretty good at that themselves, which I look for when I fund people. But sometimes there's a mismatch in the stage. There's a big difference between being the first, like VP of sales, let's say. It's often the first executive hire because they're not one of the founders. Being the first VP of sales when there are no customers, or when the only few customers they have are really friends of the founders, and coming in when there are 20 customers or 100. It's a very different type of workload. And it's not just sales. It requires a lot of thinking. It requires a lot of patience. And so that's often where you get it wrong. The person just was not ready to handle that stage, or you realize that, they can't do anything on their own anymore. They really need everybody else to do the work for them.
I think people forget that it's like, maybe a 3-month hiring process, 6 months in a role. That 6 months doesn't work out, and then you've got 3 months to kind of offboard them again and search again. It's a 12-year process when you get a 12-month process when you get a mishire, and that in an early stage company, and almost fatal in some respects. And that's why also I love serial entrepreneurs, because they go, worked with Adam last company, he comes over to this company, the chemistry's there, we built it from day one again. We're rinse and repeating this process, and I love that.
That's right. Experience in hiring is definitely underrated. You're absolutely right. That's one of the greatest skills of second-time entrepreneurs, is that they actually don't even need me to interview any of the candidates. typically. They move so fast.
It's interesting. That's what I always say though with like managers or with like VCs themselves though, which is actually like, if you operated pre-AI, pre-cloud, honestly, it's such a different world now in terms of infrastructure, in terms of stack. Having operator experience, technically speaking, then I don't think it makes a huge difference to versus now because it's so different. But people always stay the same, and actually the ability to detect talent, hire, maintain talent, retain talent, that's always the same.
But also knowing yourself as a manager or leader. Everybody's different, and the more experience you have having been in that situation, the better you are about hiring the people that are a good match for you. Are you the type of CEO that wants to kind of give somebody a mission and they're off and they just come back when they've delivered? Or are you the type that needs to know all along what's going on and I want to collaborate and I want to contribute? Those are very different. Those are two different styles. They're both legitimate, but sometimes there's a lack of self-awareness if you don't have experience having been a CEO before.
I totally agree with you. I love that in terms of knowing who you are. So we've gone through this process and we now want to do the deal, okay? We get to the deal making stage, and Keith Raboy actually said on the show the other day, it's such a competitive world. You have to know why the best founders choose you. If you can't answer that question, you shouldn't be in venture. How would you answer that question? Why did the best founders choose Adam Fisher?
Well, in my local market, they choose me based on reputation. I hope it's personal reputation, not just the brand of Bessemer, although the brand of Bessemer definitely helps. I've been doing this for a long time. One of the few that are still very active and very active across many sectors. So I've done everything from, as I mentioned, semiconductors to consumer software to SaaS and infrastructure. I hope that my name and precedes me, but in a way that relates to the ups and downs. I mean, I make it very clear to the entrepreneur that I'm choosing them more than I'm choosing the market or the particular product, and that I'm choosing them because I'm also not just choosing somebody that I hope will succeed or want to succeed, but somebody that I look forward to working with, even if ultimately we fail. And there are companies that I look back at and I think, wow, we didn't really do that well, but that was fun. I liked working with him or her, and you know what? I'd do it again. And so I think when you go back to what I said before about thinking about an investor as a partner, as a quasi-founder of sorts, somebody's going to be with you really through ups and downs, is really important. I see my role as a VC as picking up an entrepreneur when they're like on the ground because of some kind of disappointment or challenge, but also pulling them down when their head's in the clouds, when they get too giddy about some recent success or about their recent valuation or some interest from an acquirer. And that's what I try to do. And so the entrepreneurs that come to me, they realize that I have that balance. And when you express that kind of balance, when you react to entrepreneurs, whether it's good news or bad news, with some kind of composure, they become more transparent with you, more forthcoming. They'll share the good information and the bad information as soon as it comes in. And ultimately, that's the secret of a great partnership that can last.
I completely agree in terms of that real-time information flow. We mentioned kind of head in the clouds and you mentioned valuation there. I do have to ask on price. I interviewed Peter Fenton years ago, but he said something that always stuck with me, which is that price is a mental trap and it's a litmus test for conviction. How do you feel about price sensitivity, willingness to pay up, and when you will and won't stretch?
I'm typically the first institutional investor, sometimes the second. Rarely have I turned down deals in the very early stages due to price alone. That price is often a function of raising too much money, meaning they didn't ask for a $40 million pre-money valuation. They asked for $25 million in their first round of financing. That was the problem. Now, I realized that as a result, it required a high valuation. But the issue for me in that situation was much more about what do they think they're going to do with so much money? They don't know what they're doing yet. And that was a mismatch for me. So rarely is valuation alone the issue that caused me to back off. Again, being early stage, I'm not exposed to some of the growth stage valuations where really you get into exit territory, and that is very challenging. I'm very conscious of that. I try and make sure the companies I back never raise at valuations that they want to sell the company at, and I warn them of that. And again, I have the scars to explain what exactly that looks like when your last round valuation is essentially ahead of the valuation you want to sell now, and how acquirers interpret that, how you work with different sets of preferred shareholders, one that's in the money, one that's completely out of the money. It's a nightmare.
What happens for those generation of companies that are in that position now? We've seen many with multi-billion-dollar valuations on 10 million ARR, not excessively high growth rates. What happens to them?
I think it's a combination. It really depends on the strength of different shareholder classes. There are sometimes, if they need a lot more money, it's a recap opportunity, or it's a sale at a very depressed price, in which the latter investors just want to get their money back. It's not pretty either way. I don't think that entrepreneurs and their investors understand how bad that situation is. And it's not so much that it's a potential down round. Down rounds are not problematic. Much more problematic, again, are valuations that are essentially in exit territory, or far in excess of exit territory. It's really hard to recover from that.
So I hear you, but I just also hear how fundamentally fatal a down round can be to company morale, to the feeling inside of a company of progression, and it actually is just so hard to come back from a down round. Is that inflated? And you're like, nah.
I think it's inflated. I think if you were talking to a public company CEO, they wouldn't know what you're talking about. They'd say, I don't understand. My stock goes up and down every day. Why should a private company be any different? 6 months ago, the market thought we were valued at this. Luckily, we raised at that price, and I avoided dilution for all of you, but now it's back down. That's the way the market works. I think being honest as a CEO and speaking to your employees like adults and not children is the way to get past it.
You mentioned that it's often not the price, but it's a concern on how much they're trying to raise. It could be a very large amount in many cases. I often tweet about this and just the dangers of raising too much and what it entails from that. Parker Conrad at Rippling, a very famous founder in the Valley, always goes, that's a VC-ism. The best founders know what to do with the money, and actually, you're wrong, and that's just a VC trying to get smaller rounds and smaller prices. Do you agree that the best founders do know what to do with the money and can raise larger amounts? Or do you take my perspective that actually, no, raising too much creates a ton of excess, speed challenges? Which side do you sit on?
I think it depends on the stage. I think there are growth stages where there's just tremendous opportunity. The company is growing very quickly.
This is pre-seed and seed.
No, at seed, I don't think so. I think it distorts everything. Everything from the go-to-market model to how you hire to the offices and the culture you're creating, it's all wrong. So I completely disagree.
How do you feel then about these, very often, 10 is low, but 20 million seeds for AI companies that we see today? Would you do them?
No, I don't. I don't do them, but for different reasons. I don't do them because the way they rationalize needing $20 million is because their 6 competitors also raised $20 million. And in that sense, they're absolutely right. Why would you be number 6 if you and raise less money? If anything, you need to raise more money and show them that the number 6th company is even bigger or better and more ambitious. That makes sense, but it's a backwards way of thinking.
It goes back to our point actually on liking things that other people don't like, and so having that one is a very different analysis.
Right. So I made several AI investments early on before AI was hot, and luckily I got out and with nice exits. But since AI has become what it is, I've run the other way for the simple reason that I just can't make sense of the competition. I don't like betting on a horse race. And this is what it feels like to me. You're sitting down in the stands and there are 10 horses and you have to assess which one is going to win.
I agree totally, but then I also fear that this is the platform shift that everyone says it is, and you have to play the game on the field and you have to move with the tide. And I don't want to be left in a world where vertical SaaS apps are killed by the kind of democratization that AI tooling brings and the ability to build your own instead of buy. And so I don't know what to do.
Well, I know it's hard to sit out in an entire market, and it feels like AI is like the equivalent of cloud. And so I'm not suggesting sitting out of anything related to AI. Of course not. I'm talking about some of the very mainstream type AI use cases, especially those that consume enormous amounts of capital with very low margins. As an investor, you need to decide, are you going to make your mark by having hit one out of the park, so to speak, using baseball parlance, or by having multiple hits and maybe also getting lucky with one that you didn't expect to get lucky. My preference is the latter. I go for base hits. I try and get on base.
What does that actually mean?
It means doing things that are within your control. I just, like I said before, I don't think that the way you build a big company or the way you get a big exit is by investing in the most ambitious companies growing the fastest. Those are also the companies that crash and burn. My experience has been different. It's been companies that require patience and that over time figure it out and surprise everybody out of nowhere. I mean, Wix, by the time it was known, it was already public for 2 or 3 years. And then people look back and they say, in retrospect, oh yes, it was obvious. And I mean, when we invested, it was, these days we call it a SaaS company. But back then, even though we used the term SaaS, it wasn't a SaaS company. It didn't fit our strict definition of SaaS. We were learning as we went. It was PLG, but PLG hadn't yet been invented yet. This is what you're looking for. It's not just being ahead of the curve in terms of the market. It's being ahead of the curve in terms of how you think, how you build the company. And you're going to miss some of the terms. There's not going to be a term to apply for it. And you may be at a loss of words. But you're going to say, I see here something that I haven't seen before, and I really like it. And so when I go back to Wix and I think, what did I like so much? Yes, I liked the concept of the product, and I liked the entrepreneurs. But there was something else they were doing that shocked me. They were doing things in the area of marketing, online marketing, that I didn't know you could do. There were all these types of, they called it guerrilla marketing. That was the term they used. But it fascinated me that they were thinking about that so early on, and that they would spend, at the time, $50,000 to buy a 3-letter URL. I mean, now we think, oh, that's obvious. But this is 2006 that they decided that they should definitely do that. I loved that way of thinking. I'd never heard that before. And I realized, this is something special. If they could do that over the last 12 months, I think that was about the time I invested, then they're probably going to do some other interesting things over the next 12 months and over the next 12 months after that.
Can I ask you, you mentioned there kind of about the base hits. I had Brian Singerman on the show from Founders Fund, and he said that great venture funds are due to capital concentration in the best companies, and capital concentration limits are the enemy of great returns. Do you agree with that in terms of the importance of capital concentration on a per company basis to really get great alpha in venture? Or as you said there, do you prefer the more bets and get lucky on one or two?
I don't know if I fit either. There's no question that at the end of the day, most of your returns are going to come from very few deals. It's not going to be spread evenly. That's a fact. The question is, can you recognize it early on, or can you recognize it really at any point? And I don't think you can. I think we delude ourselves into thinking we know exactly which company is going to be a big outcome. We don't. These are all retrospective stories that we tell ourselves, and we do it over and over again. And even I do it myself, and I have to go back and look at what I actually wrote to see what I actually thought and remind myself, no, Adam, you didn't think that was going to happen. It wasn't that. You didn't. That was not yet a term, or that was not yet a concept. And you've just kind of told yourself the story that makes you feel good.
I totally agree. In that case, should we do reserves at all? If we cannot predict the winners in that way, and it's us, looking back with the benefits of hindsight, surely we shouldn't do reserves then, or we should do reserves to everyone as a kind of contract agreement.
Well, I think reserves are for fund management. I don't think reserves are a commitment to a company or a team. I don't think. I think in order to manage a fund properly in terms of resources, you have to have some sense. It's just important to realize you have to assume that there are going to be some companies that you abandon to a certain extent in terms of not investing much more. It can't be a situation where everything you've invested in is going well. You always have to decide which ones are just not good enough relative to the others. And so I think it's very important to have allocations, but it's also very important to constantly adjust them.
But then on the flip side, you also have to be able to tell which ones are good enough. And that's my problem, which is like there are many companies where I've invested in the seed, they've grown unbelievably fast. If I were to do reserves, I would have concentrated capital into them, and they were not sustainable growth. They were in consumer, they were in whatever they were in. And that would have been flawed because, again, we can't predict which ones win.
That's right. Again, everybody has their own personality in terms of investing. Mine is I'm risk averse. I worry more about losing on those types of investments than having missed an opportunity to make a bit more money. It works for me. I don't necessarily recommend it for everybody, but I don't mind it. I don't mind having missed an opportunity to invest $3 million more in a company that could have generated another $30 million of gains. But I do worry a lot about doubling down in a company, investing another $20 million when it was growing at an unsustainable rate and with way too much burn. That causes me much more pause. And so I'll pull back on those ones.
Has that risk aversion ever hurt you? Say you could have done the Wix B, you could have done the Wix C, whatever, or you could have done the fight, you could name any of your winners. But has there ever been like the real chance?
Yes, I have 23 exits to my name, and in every one of them I had an opportunity to invest more. So that's really easy.
Would you not be a better investor if you didn't have that risk aversion then? Given your ability to pick clearly with 23
every decision you make just affects your next decision. So it's really hard to do this kind of counterfactuals. I may have gotten ahead of my skis, so to speak, in some of these investments where all of a sudden I doubled down, let's say on Wix, and then there was a challenge. And there were challenges. And that might have affected my confidence to then invest in the next company, which in this case might have been Fiverr. And I might have said, you know what, I've gone too far on Wix, I'm going to hold back on Fiverr. So you have to think about every decision you make and how whether it's successful or not, how it may impact your next decision.
I understand completely. I'm just thinking about the 23 exits, the ability to concentrate capital and some massive winners. If I'm sitting in Bessemer as like internal partner meeting, I'll go, Adam can pick unbelievably well. He's concerned about future decision making on reserves. Let's have an independent person on the team actually analyze the reserve decision making process so it doesn't impact his decision making. We kind of protect the preciousness of your decision making and pick, but someone else does it. Do you think that's a good way to do it? You sometimes see firms
but
have
if we're looking over a finite period of time, that's easy in retrospect to say that. If you now tell me to change my strategy, this could be the worst decision of my career, and I could be investing 3 times in every single company, thinking that everything I do is fantastic, and discover that I've just erased half my gains. I don't think that's really possible, but you know what I mean. No, I don't think so, and I don't think you can really change your style that easily. You get out of your comfort zone when you invest a lot more money at a lot higher valuations. You actually end up behaving a little bit different as a board member even. When all of a sudden you have 100 million of cost basis in a company, in which I do have several companies where that's the case, the way you think about things is more risk averse. All of a sudden you kind of shift gears and you start thinking, wait a minute, how do I ensure that I get 1x? Forget about the 5x that I dreamed of. And if you don't want to be in that situation, then don't get there.
What do you think are the biggest misalignments between founders and investors? Like you said there, that, when you have 100 million, you bring a very different mindset to risk. What do you think are the biggest misalignments between founders and investors?
Well, early stage, there's not that much because generally at a certain point, you've acquired enough, and hopefully the company is accreted in value, and you're kind of both in the money. I think for later stage investors, there's some misalignment, especially when founders start to sell secondary, and those growth stage investors are kind of stuck. And I think it's just less appreciation for that growth stage where founders tell themselves, listen, I worked to get to this point. I spent 7 years, toiling and getting a low salary. I deserve to sell. But the growth investors don't care what they did in the past. All they care is about the future that didn't happen as they hoped it would. And so there's true misalignment. I just don't think the same is true of early stage.
Have we got to the stage in the cycle now where late stage investors, they just want their money back? Just give me my money back. I want to recycle. I want to distribute. 1x is fine.
100%. That is exactly what's going to happen over the next 24 months. Various ways in which to get your 1x. And when you know that you want your 1x, you want it now. You don't want to wait 2, 3, 4 years from that. Not only from an IRR perspective, just in terms of the time commitment and the risk. As time goes on, the risk can get worse. That 1x can become 0.75x or half an x, and then you get even more stressed about it. And I don't think entrepreneurs fully appreciate that situation when they have a set of investors that just wants their money back and how that affects decision-making at the board level.
Do you think that's fair to ask of founders? Like, when you actually think about it, we invest in you because we believed in you, the company, the vision, whatever it is, even at late stage. It's not your money anymore. You invested that. You have no right to be like, I want my money back.
Oh no, they're not going to say that.
Well, sometimes they do.
I'm not on those boards, to be honest. Not yet, at least. I I think if I was, I would tell the entrepreneur to ignore them and to figure out how, to tell them why they need to be patient and why you still appreciate them as an investor and understand that it might not be the outcome that they had hoped for, but there's a way in which to do this that is in the interest of all shareholders, including them, and they, still get their money. They still will get their money back, but that's it.
But Adam, help me, because M&A is not exactly an incredibly active market. Obviously Figma put a lot of dampeners on a lot of M&A hope. So where does that liquidity come from? Where does that 1x come from? You said about kind of depressed pricing and sales there.
I didn't say it was easy. It depends on the company, I think, and the price they're willing to sell at.
But do you think there is even liquidity windows open in any ways for these 1x's back?
I think there will be. I think it's just a matter of price and matching it. A lot of these companies grew very quickly, burned a lot of money, but without burning a lot, they can't grow at all. And they have to right size, and all of a sudden that company that was growing 100% and is at 50 million is now still at 50 million and not growing at all and still burning money. And how much is that worth? It's worth a very low multiple of that. And I do think there are acquirers for these companies, but it's hard to get there. It's like you always want the previous deal. This is the stage where you always want the previous deal. You want what you could have had before, and you have to preempt. You have to preempt that, meaning you have to realize that it only gets worse from here, and so you actually have to get ahead of it and accept what is ostensibly a low offer. Because if you wait, you're going to want that offer, but it won't be around anymore.
It's so true. You always want the previous deal. The amount of times I've said, I would have loved to have done Adam's last round. And so often.
Well, in an up market, it's the other way around. You kind of want the next deal because it all goes up. But in this market, you want the previous deal. But it's much harder psychologically to realize that you're on your way down. You don't need to act like it. You actually pretend that that's not the case, but you need to decide as if that is the case. You're sliding down the side of a mountain, right? If time is not on your side, you're going to hit bottom. And so you want that previous deal and just preempt it. Try and find a way to get the acquirer to make an offer you don't really want, but then to take it.
So speaking of kind of taking the offer, Daniel at Choco said, many investors have good investments. Adam has good exits. The man knows how to make money. My question to you is, how do you think about when to sell, how to think about liquidity? What have been some big lessons for you there?
When to sell, it's typically when I think the company has peaked or is about to peak, I would say, ahead of it. If it's peaked, I'm already it's too late.
Are you good at predicting the peak?
I am. I think I am. That's one of my skills. I am, because I have a lot of exits where that is the case, and it's a combination of the business just not really working the way we want it to. It might not be efficient. The market might not be as big as we thought. We may not be able to spend money to make money, if you know what I mean. We can double the headcount, but it won't really change anything. Maybe because competition is really gaining and this whole market's going to be awful. Low margins, too much competition. And so you have to be ahead of it. You just got to be slightly ahead of everybody else. It's just like investing. You just want to be 6 months ahead of everybody else. Same thing at exit. You want to be the first to exit. You don't want to be the last. And so in orchestrating this, the first thing is to make sure that the CEO is on the same page. Sometimes they are. Sometimes they're the first to come. Other times you have to actually work with them and explain the risks of continuing with the same strategy. And that takes time. But if you have a good relationship, if they understand that they're still going to do well, make money, or that you're going to take steps to ensure that they're going to make money on any kind of outcome, you can work together and figure out, okay, what do we do now? Who are the likely buyers? How do we get close to them? Now, this is not a decision that within 3 months, then you have offers. It's typically a year-long, if not more, process. Now, this takes me back to how I invest in entrepreneurs and what I look for. I look for people who are, like I said, storytellers, have charisma. I look for people who I think acquirers would want to buy, like the person, not just the company and the product, that they get excited about that person leading a division or a group within their company. And then I tell the entrepreneur, listen, as much as you built a great product and you're in a hot market, let me tell you something. We're not going to be acquired for that. They're going to acquire you. Now, don't let this get to your head, but you need to understand that if you can win them over the way you won me over 4, 5, 6 years ago, you got it in the bag. And so I would say at least 6 or 7 times, I've had exits where, the company was almost worthless, less than $2 million of revenue. And we had offers that shockingly good.
Why would they shockingly good for a company with less than 2 million? Is this a pure technical buy? This is a pure acqui-hire?
It's a combination. It's never just technology. It's usually a team, technology, and of course timing. And you have to ensure that the buyer feels like they're getting something that they couldn't otherwise get.
I think the thing that's terrifying in venture distributions is when you look at the kind of historical arc of venture distributions, there's these tiny finite windows, which is really where the majority of returns are predicated. And if you don't fit in them, it's very hard to make money in this business at all.
Yeah, timing is so important. It's hard to know where you are. All you know is the past. You have no sense of the future, but it's critical. And ultimately, these companies that I mentioned, within a certain amount of time, it was clear that, wow, we sold at peak. Either it was market peak or company peak, or the acquirer themselves afterwards, their stock dropped. Now, I've had the opposite. I've had situations where acquisition offers were pulled because something happened to that acquirer, in other words, the worst possible time. But that's how you engineer it. And of course, it's easier when it's not a very well-known company, when there weren't a lot of headlines, when they're not burning a lot. Acquirers don't want to buy ongoing losses. So you have to have a manageable burn. And of course, the various ways of looking at that, but it's typically as a percentage of the acquirer's EPS, how much they can absorb, how many kind of losses they can absorb.
Adam, I've loved this, but I do want to ask one final question before we do a quickfire, which is slightly off-piece compared to what we've done, which is you've taken a very proactive stance, and Amit on your team told me to ask this, so I hope it's okay. He said you've taken a very proactive stance, really fighting against Israeli judicial reform, and now fighting for Israel's right to protect itself against global anti-Semitism. And I've seen some of these, especially on Twitter. Why did you decide to be so active publicly, especially also, and it sounds awful, when it's easier to not, and most don't?
I think I just reached a stage in my career when I don't really care for any repercussions, and that I trust myself to express myself in a way that is honest and not antagonistic. And, if you're going to have an independent mind, and live in a place that's free, if you don't feel comfortable expressing it, then it's just not worth that much. And so that was a realization I made. The first was in 2022, when the new government in Israel was formed. Even before this so-called judicial reform was announced, I could see it happening, and I wrote about it on my Medium blog. I said this government's going to try and gut the independent judiciary. And I explained why it was so bad in the context of Israel's political structure. And it was a very vocal move. But I said, I don't care if there are some people, entrepreneurs, that don't agree with me. What's the worst that can happen? They won't come to me, fine. But I felt that was a fraction. What I didn't realize that there were a few others who felt exactly as I did. Venture capitalists in this case, who also spoke out. And within days, the entire tech sector, 90% was on the same side. That's reassuring. I think maybe a better question would be, what if there was more of a backlash? Would you have continued? I think so. I think carefully about all these issues. And I attempt to think carefully and patiently before I write. Obviously, sometimes you write quickly on platforms like Twitter without thinking it all through. But again, I trust myself. I know the issues. And I'm not afraid to say also if I make a mistake that, I misspoke or I miswrote, although I don't think I have in the past year.
You have had debates with some very prominent Silicon Valley investors, entrepreneurs. Bluntly, PG comes to mind. Is there backlash there, though? Because there's a PG army.
No, I'm not aware of it. Actually, there was never a debate. Most people I've engaged with, they blocked me right away. So they're not interested in any alternative opinions. I would have liked to have a discussion. No, the Israeli market's very different. That's my market. It's not a name that's spoken about much. Mine is more prominent, so I didn't think much of it.
Listen, I've so enjoyed this. I want to do a quick fire. So I say a short statement and then you give me your immediate thoughts. Does that sound okay?
Sure.
Okay, so let's do, what have you changed your mind on in the last 12 months?
Well, I'm usually the kind of person who says that I am pessimistic about the short term, but optimistic about the long term. And the last 12 months, I've felt the opposite. I hope that reverts.
You optimistic about the short term and pessimistic about the long term?
Yes. In the context of Israel and business, I think business has bottomed out and things are getting better for now. But I do worry, for instance, in venture capital, that there's still far too much capital to make this a business that we can all do, or even a lot of us can do well in. And when in the context of Israel, yes, like we've, I think, back where we were even 12 months ago in terms of this judicial coup, we're in a much better situation. I think security-wise, over the last 3 months, things have actually improved, even though it doesn't look like that. But I do worry a lot more about the long term, and that's a bit of a flip in my mindset. I hope I revert back to where I was in over the next 12 months.
Geopolitically, are you optimistic? I'm quite.
No.
Yeah.
No. Again, short term I am. But I worry about there's a lot of long-term trends. In the case of in the U.S., I worry a lot about isolationism, which I actually think is the natural state of the United States.
Do you not think we're moving to an isolationist world, though, actually? And we actually operate in independent blocks. There's China, there's Europe, the US.
We won't. We're going to attempt that, and then we'll discover yet again that it's impossible and it's a disaster. We're gonna recreate the.
Is that a decade-long failure attempt?
It probably is. It probably is, yeah.
Do you worry about Trump getting in?
Yes.
Do you think he will?
I think there's a real good chance,
Yeah. What's the biggest misconception of the Israeli startup ecosystem?
Oh, it's probably that they're all techies and they're all in cyber security, which is just not the case. I've backed a lot of entrepreneurs that have no technical background or minimal technical background. And obviously, I have very few, if not any, cybersecurity companies. I've got entrepreneurs who were lawyers, in HR, you name it. And so I think that's a big misconception.
The thing that I did find was the commonality of the name Ido or Ido. When I was speaking to him, I'm like, Ido? I have 50% at Ido. I'm like, Ido? Yeah, that's me. Okay, good. Tell me, what's the best investment advice you've received?
I would say there are two pieces of advice which are contrary. The first is that when things are just going awfully right in the beginning, like just get out, like stop right there. In other words, if within 12 months or 18 months, just all your assumptions are wrong. The entrepreneur is awful to work with. The market doesn't look right. Just stop right there. Don't try and fix it. But the second piece of advice that I received was that oftentimes 90% of the value that is created in the company happens in the last 12 or 18 months of the company's life. And so that requires both patience, but also recognition that sometimes that's the way it works out. And there are companies that's the way it's going to manifest itself. And so it's that combination of being able to cut, but also being patient and knowing when to apply what.
It's a hard skill to have. Biggest investment advice that you give most often to people?
For fellow investors?
Yeah.
Well, generally when they're starting out, I tell them just get points on the board, which is to say, again, don't try and back the biggest thing. That's just not the way it works. Just get some exits. I'm a person that really understands the psychology of investing, and I know what it's like to get ahead of yourself and to have $30 million feel like they're going down the drain. It really affects every subsequent decision you're going to make on that company and any other investment. But if you've invested $5 million and there's since been an up round and the company's doing well and it's now valued at, let's say, 3x of that, you're going to feel good. You're going to have a lot more confidence in making your next investment. And so my view is get points on the board. Of course, when I mean points, I mean actual exits, but you don't have much control over when that happens.
Timing-wise and stuff.
But that I believe you need to have that initial foundation of investor confidence, even when it's unfounded, but that helps a lot.
Have you ever got ahead of yourself as an investor?
Of course.
What happened?
Other investors and the company was doing very well. Other investors thought it was also amazing. They wanted to lead a very large round at a very high valuation, and I had to decide: do I just bow out, saying this is way too much, or do I do my pro rata? But in these cases, my pro rata is enormous. You know, it's 30, 40, 50 million dollars, and then all of a sudden, I'm truly doubling down in ways that I never imagined.
Did you do it?
In a few cases, I did. I'm not sure yet whether I regret it or not, but I feel uncomfortable in a few cases.
What was the biggest sin of the ZIRP era, the zero interest rate environment era?
The biggest sin, well, I'm sure most people would say just the valuations. I think it's more about thinking that you could be number 3 or 4 or 5 in a market and still succeed. I think that's such a mistake on the part of entrepreneurs, investors, and even employees who join these companies. Obviously, there are exceptions, and everybody will cite the exceptions, but that's so often the clearest path for failure, because you knew it from the get-go that you're not the pioneer, you're not even the second, and you're just kind of riding somebody else's wave, so to speak, that they've created for you. It's easing, it's helping you raise money more easily, to recruit, maybe even to sell, but it's not your wave.
Where will you be in 10 years, Adam? I know it's the hardest question, but where do you want to be in 10 years? 2033?
Well, it's more about how I'll spend my time. I'm hoping that I'll have a smaller board load and that I'll have more time to read and write, and probably also more mentoring. I really enjoy working with younger investors or newer investors and imparting whatever wisdom I can. I think a lot of the things you learn over this kind of a period, 25, 30 years, you learn them too late to make them truly valuable to yourself. And so the best thing you can do is then try and give it to younger people and hope that they'll take it and work with it.
Honestly, I think it's the biggest joy of doing the podcast, which is bluntly, I learn from you, I learn from the best in the business at hopefully younger ages, and actually can impart what you know now on my career earlier. That's why I started this show.
Yeah, but that's humanity. That's what separates us from animals. We can teach our young, so to speak, what we've learned. They don't always listen. And sometimes you have to go through the same experiences. It doesn't matter what somebody tells you. You actually have to make the mistakes. And that's fair. But
that's called marriage, Adam.
No, but this is what progress is. Progress is we actually get to learn from those that came before us, even if it's 10 years before us or 5 years before us. And so I think it's an important part of our role, in society, in business, and technology.
Adam, I've loved this. Thank you so much for putting up with my very off-sheet questions, but you've been fantastic, and it's really been one of my favorites to do.
This has been great. Thanks so much.